And we've been tracking along here with just the normal like intraday movements, but it's always a good time, or now is a good time to step back and kind of take a look and see like what's going on at the bigger scale in the bigger picture, and kind of look through some of the different types of data, and really just kind of answer some questions that you guys have. I want to try to make myself accessible, especially during challenging times like this, where you just see markets going down, 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 and we're looking for a bounce, but at the same time, we still need to have patience for the first wave here to kind of complete. So I hope you guys brought some questions. Pretty much what I was planning on doing here was just kind of going through the high level chart of like the Nasdaq and the S&P. I can touch on the downs and small caps. I can also go over some other things, but mainly for everybody, I'd like to try to take maybe like a half hour or something to kind of talk through sort of like the macro view, and then drill down into the more of the micro sort of view. And so maybe that'll help you guys be able to plan effectively for the next phase here. Does that sound good? Or is there anything that you guys really, really wanted to cover so that I can write down here on my handy dandy notebook?
Hey, Gaines.
Sir.
Ron DeLaGuardia here.
Hey, Ron.
What are we not allowed to talk about?
Wow.
I
don't think we ever had that question.
There's this conflict between who's subscribed to the modeling work at Cestrian and who's not. So you can't talk about the modeling results when you're on Inner Circle or Trading Gains. There's boundaries between. So is there anything that's off limits?
No, not really. I mean, I can still answer some questions on maybe like some signal flow stuff. I have a little bit of knowledge about it, but hopefully, you guys don't get me in trouble if I comment on it.
Okay, so any comments you made today about the market on your platform, Trading Gains, we can bring up in this discussion?
Yeah, absolutely.
Okay, good. Just wanted to make sure I don't make any trouble.
No, it's a good question. Yeah, I always try to make sure I don't make any trouble. You can't really see it from there, but I still got a lot of gray hairs that have come up from some of these things.
Yeah,
so.
I hear you. Yeah.
And it's great that some of you guys are on camera here. That's awesome. Normally, I'm just talking to the Hollywood squares with just all the nobody's faces, so I can't see if my jokes are landing or anything. All right. So now we got we've got the dedicated here on a Friday. Well, first of all, happy Friday. Hopefully you guys, get a cocktail or something like that, depending on your, your time zone. Yeah, I'll be, hey, there we go. All right. We got a couple. Great. I did not have a chance to go grab one. It's a little busy, but that's all right. That there's always after. Anyways, so let me pull up the Nasdaq here, and we'll get rolling. And if I do have a tendency to talk too fast. So please stop me if this is going a little too fast, or you have some questions or anything that might be relevant to the discussion. Happy to stop and reiterate. Sound good?
Yep.
All right. Cool. So what we're looking at here is the daily view of really just the Nasdaq in general. I like to use the US 100 ticker because what that does is it kind of blends together futures and also just regular Nasdaq. So it kind of gives you that constant charting platform. And one second, I think I'm getting a little feedback. If anybody could go on mute until they have a question or something, I think that might help. But what we're seeing here is a pretty interesting development where our sorry, one second. There we go. I think I got it. So what we're looking at here is a breach of a long-term trend line, and overall, there are a lot of people that, and again, like sometimes if I go nuts about wave counts, please pull me out of the weeds. But there's a lot of people that think that this is a impulsive wave count, and I don't disagree. I think there's different cases for both, and what matters with that is essentially what comes next. And what we're what I think we're looking at here is just a massive irregular sort of pattern here from the market. And I think that it's definitely been fueled by the AI trade. And there's been some, like we had this time period here where there's 3 months just worth of controlled selling, and then we just kept rocketing up to the moon here. We had this little Japanese yen carry trade blow up right around July, August, and what that ended up doing was that set up that last leg up to the highs here that we saw recently, and also with the S&P. One second, sorry, let me clear this junk out of here. With the S&P, we kind of have the same sort of situation where I still don't think that it's you can make the argument that long term the trend line has been breached. However, just kind of freehanding it over here, it does look like a really, really tight, like ascending sort of wedge. And what that means is that once we break down through like a long-term trend line, it's incredibly bearish. But not only that, but as soon as you dip down below that 200, which is the turquoise line, the 200 exponential moving average, what you end up getting in it, when flip back to Nasdaq here, what you end up getting is there's different strategies, of course, and lots of strategies are very effective, and you just got to master them, right? But there's a lot of people that like to trade above and beyond, or sorry, above and below the 200 exponential moving average. So once it heads below, then people start selling, or once it heads above, then they start buying. I think longer term that's a good strategy, but if you're trading and trying to maximize your return on a lot of your capital, I think that what is an effective strategy is just trying to understand where the direction is headed next, and not necessarily kind of have a hope and a prayer that it's going to go up. It's more about longer term understanding how the markets move in waves, and understanding the real pivot points and how long those can actually take to develop. I think that's also where people get tripped up is when you're looking at a large rally that's kind of coming to an end. A lot of people are in like disbelief, and they're like, well, no, it's people are going to buy the dip. So when you kind of zoom in, you see, and I'll go through some of these in some more fine bits here. But once you zoom in, you can start to see that there's lots of buying here at this 200 moving average. Not so much the 50, which is in purple, but the 200 is really the important one. And then once you start to get to major trend lines like this, you can see that there's usually one big day that essentially cements the breach of the trend line. And that's always like that's always like a calculated thing. So if you think about it, like if you're an institution, okay, and you're watching this thing go up and up and up, ever since we had that Japanese yen carry trade blow up, that was sort of like the shot across the bow, right? And I always kind of thought that was the case. And if you guys have been around, Ben, I know you've been here for this, but right around in this area where we see that dip here, this is where I think everybody thought there was going to be a continuation of the trend down, and instead we got another leg up. So this is where I think I entered in some of those short positions that you guys see on the books that I've been making fun of for quite some time. It's just my money in flames. That's all right. We'll get out of it. But anyways, so I think the important thing to recognize here is that once you guys have a little bit more of like a firm understanding of like wave counts and the larger scale, then you can start to dissect them in the lower scales. And if you guys are familiar already with Elliott wave theory, that's great. I highly recommend the Frost and Preacher book. That's sort of like the Bible. If you guys go into my getting started documents, it's just one document. If you go into there, at the bottom of the document, I have a couple of books there that I recommended. One of them is free. It's like a PDF. I don't know if you guys know Robert Ballin at all. He's kind of like one of my mentors. He's a brilliant trader, and he wrote a book back in the 70s, with like Forex pairs and things like that. But it kind of like, it's that extra primer on top of the Frost and Preacher book for Elliott waves. So anyways, those two I would highly recommend if you don't have a firm knowledge of it. So to kind of get back into the get back in the groove here. After we saw that dip kind of get bought up here, we now see this sort of five-wave, well, final, I guess you could say, final five-wave, hurrah, up to the top here. Now, there's a lot of people that thought we were going to do something like, something kind of like this, where it's like a lower low, like a W. And that's kind of what I thought too. I thought, the dip buying is strong still, so we might find some support here in the 200, and then we might bounce up a bit. So we might see something like this and then head down. And ever since it started sliding down further and then also broke the trend line, that's a very important development. And why it's important is because that's sort of like your signal that says time to get out. And again, like I can't give advice. I can't tell you guys what to do, but what I can do is I can at least try to teach some of the things that I see, like with volume, with some of the different data that we're running into. I'm sure you guys have heard, deterioration of, economic news. There's a lot of layoffs in the news, things like that. So I guess long story short of it is there's a lot of negative things now that are impacting what moves markets. And it's a very different change from what we used to see, right? Like I'd say even just a month ago or a month and a half ago, we were flying high, everything's fine. And now all of a sudden Nasdaq's had like about a 15-ish% pullback here. So let's measure it. About 14%, sorry. So why we kind of want to talk about like where we're at and what we're doing is because it always sets up the next sort of, the next cycle, the next wave countdown. And whenever you have a major trend line breach like this, that's like your signal that it's the end of the previous trend. And once that's been ended, now you want to try to calculate where your bounce points are going to be, and then what's your strategy going to be to either exit longs from a prior trend, or essentially just reposition yourself and try to make lemonades out of a crappy bag of lemons, I guess. So what we've been doing is every kind of day here, and I'll zoom in a little bit. But before I do that, does that make sense as to kind of like what the overall picture is? We kind of breached a big long-term trend line. We've had lots of poor economic sort of things coming out, tariffs, lots of uncertainty. Any questions about the larger economic backdrop from anybody?
Well, Gaines, I have a comment, and this might be ridiculous, but at the end of 2024, all the major names in stock market trading, like for example, Liz Ann Saunders, who's the chief investment officer at Schwab, and a lot of the people on Twitter, like Ryan Dietrich, we're all making predictions about what to expect in 2024. You probably read some of those predictions, right, of what was going to happen. And virtually every one of them said that 2025 was going to be very volatile. It was not going to be like 2024, but overall, they expected the market, the major indices, to end up at a higher price value than they began the year. In other words, if you invested in the S&P 500 or the Dow or even the Nasdaq in January, by December, you would make money. So you're saying that outlook has changed, correct?
Yeah, and it depends on the individual analyst. These are also the same people that had to revise their price targets higher when they were calling for a pullback in 2024, because statistically, having 2 years 20% plus back to back, it's only happened really 3 times in history. So the odds of that happening were pretty slim. So you were seeing about mid-year last year where people were raising their price targets from like 5,600 for the S&P to 6,000. Or sorry, that was more about like spring. Sorry, I'm still a little under the weather here. But you see analysts, especially in typical bubble behavior, you see a lot of analysts always moving their price targets up because they don't want to be wrong, especially be wrong in public, which is worse, because then people always troll you on it. But I guess we have a better setup because, I can be totally honest with you guys. And if it's wrong, it's wrong. I'm sorry, but at least there's a sequence of thoughts behind it, and not just, throwing a dart at the board and targets and things. So in my opinion, at least, as an analyst, looking at all the data, I live and breathe this stuff. I mean, I'm probably looking at this stuff 12 hours a day. My wife's mad, all that sort of stuff, but when I'm looking at this, markets do have a feel to them. They really do. Well, like when you're watching price action, like with Nasdaq, Nasdaq moves a little fast. The S&P moves pretty decently fast compared to like the Dow. So that like the Dow trades a little slower. Small caps, no one knows what the hell happens with small caps. But but from like just a trading perspective, you have these macro trends that converge, and then there's longer term cycles that also converge. And the longer term cycles, I think everybody that did expect there to be, and myself included, where I expected there to be this pullback in 2024, it went on another 9 months. And unfortunately, I had shorts to drag along with it. But the lesson there is that, again, typical bubble behavior, it can keep going and going and going until finally it bursts, with some sort of catalyst. And you need a large macro catalyst to do that. Tariffs is one of them. Okay. And also with the yields, yields being elevated. I think also too, the Fed kind of shot themselves in the foot in December where they lowered rates. The administration wants lower rates because we have really high debt to finance, and with lower rates, it's going to cost us less to finance that. And this might not be popular opinion, but it's just more of a thought. Okay, so don't take it as take it with a grain of salt, I guess you could say. If you cause problems for the market, and all that air kind of gets let out of the balloon, all that excess, then inflation gets tampered by default because people spend less. There are layoffs and things like that, but we have been seeing more of that in the news, right? Yeah. So what's been happening is I think that there's some sort of, there has to be a little bit of short-term pain to get the long-term gain, where we've had a lot of excess and we need to have some sort of pullback in order for market internals to get more back into equilibrium with valuations that are more realistic. Like I was joking around about it the other day saying, when the Nvidia is more than the GDP of France, it's a bit of a signal for, but that doesn't necessarily mean it could end tomorrow, right? So as traders and savvy investors, what we want to try to do is we want to try to get all the information that we can at when it's available, and try to make the best decisions. So and I know this has been a long-winded answer, but I feel like it is a very appropriate question, because long term, a lot of these analysts will make these projections and then have to keep moving these targets up. But sometimes they're not really looking at all of the different factors. And again, I don't know that's a guess, but sometimes there can be other influences on them. Like they could have subscribers, or they could be on the news, and they could be trying to they could be, I don't know, in charge of something that if they say the wrong thing, it's going to tank, that kind of stuff. So there are always these external sort of pressures that more famous people, I guess, can have that might alter their opinion. So also too, for example, like somebody like Jim Cramer, right? So Cramer he'll say, buy this stock, or bullish on this, and eventually the party's over, right? Eventually you get to the point where some of it just becomes ridiculous, and even though you can see it on, like I can see it on the screen, like all the excess and stuff, but when it kind of comes full circle, eventually, things do return to the mean. But the mean is so far away that's what's going to be, I think, the most scary thing for people, is that how deep is this correction going to go? And I do think it's going to be a pretty deep correction. I think we need one. I think it's been overdue, at least by 9 months. And I also think that we're also at the end of a very, very long-term bull cycle for about 18 years. And if you guys have some free time, what I would highly recommend is there's a lot of research on cycles, just longer term cycles. There are cycles in nature. like cicadas, right? There's all these different things that once you start to stitch them together, you'll realize that a lot of things do come in cycles.
Yeah.
And so the same thing happens with Fibonacci levels. That happens in cycles. There's convergences of numbers like that. And if you're mathematically adept, what you start to see are these patterns that emerge. And what I've been a big fan of is recognizing the patterns and then trying to make sure that you understand like what comes next, right? So I guess suffice to say that, because I don't want to beat this to death, but I think the cycle that we're in is it has pretty much ended. Even though it's in the very early stages of it, I think probably what you're going to see is again, depending on how far this heads down, the longer the first leg gets, I think the more serious the second leg is going to be, or even third, fourth, fifth wave, that kind of thing. And kind of like when we started out the call, what I was saying before is, okay, everybody kind of thought we were going to maybe do this, and that's not so bad. I mean, that's maybe like a, let's say 20% correction, right? Instead, what we've had is a deeper cut, which is getting a little scary because we've gone 14% so far without any real measurable bump. Now, if I'm correct on this, and what we saw today is like the top of a let's say a triangle in a wave 4. So if it continues down here, let's say it's a little bit sub 19,000, and then we head back up, that makes a much deeper second leg correction. And I think that's where, sorry, my wave looks a little weird, but you can kind of see what I'm saying, right? Where that's assuming that it is a ABC sort of correction. And I don't really think that that's going to be the case. What I've noticed in the past is when you have, or at least like when you study these things, you notice that once the cycle changes, waves are longer than you've originally anticipated. And it might not be apparent until it's, halfway done, or halfway through the, the butchering of all these things. Now, markets don't typically go down without any sort of measurable bounce, more than like 10%, unless there's a, very long-term sort of cycle change. And I mean, again, I don't have like data I can show you guys to support that. So, please take it with a grain of salt that you're kind of going on the gains brain here. So I'm, pulling things out of my head here, out of the archives, that have stuck out to me over the years, like just like finance classes and things, with masters and all sorts of stuff. Or just, talking with people, again, like Robert Ballin, like one of my mentors. I mean, he's been trading since the early 70s. The guy's excellent, author, wave count stuff. He's just very, very good. And some of the things we've talked about in the past have been these major cycle changes. So to kind of summarize and kind of, move on to the next thing here, that macro sort of conversation is very, very important. And your trigger there with like the different analysts and, price targets and things like that. This is where Alex and I kind of differ a little bit, where Alex is very long-term bullish, which is, there's nothing wrong with that. I mean, markets go up, right? But markets go up more than they go down. However, sometimes you have to look at the tea leaves here and kind of discern whether, the correction that we have is going to be a short-term flash in the pan, just because of the volatility. And some of the bearish sort of takeaways that people have been having with tariffs and things recently, or whether it's going to be one of those things where it's a long-term sustained bear market. I mean, we haven't had one for a long time. And again, not necessarily saying it's going to happen right now, just saying it's going to, eventually you're going to see some of these things. So the strategy is really what's important. Strategy, like once you have these big breaches, what you want to do is you want to essentially hedge your uncertainty, or hedge market uncertainty. So if you have like, big buckets of money and you've accumulated this over time, the best thing I can tell you is to preserve that capital. And how do you preserve the capital? You want to skip corrections if you can. If you don't like to short, that's totally fine. Shorting is not for everyone. But what you'll want to do is you want to sort of assess the situation. And again, if we have this sort of move down like this, the next step is, how do we exit trap longs? You can always reset the long trades. And to be fair though, like we've had so much of a run up here that even when you zoom out and you look at these these trades, or not trades, even when you zoom out and you look at this is still not much compared to compared to the longer term scope of things. Now, if you're looking at this from a long-term perspective, I'm sorry here, one second. I gotta let my dog in. She's nuts. One second. Sorry about that, guys. You have to sit in awkward silence for 10 seconds. Right. She's just gonna keep whining by the door, let her in. So let's do like a proper wave count on this. So assuming that we hit some sort of bottom here and we bounce up and do something like this, I still don't think that this is going to be it. There are some patterns that you can see that start to emerge with things like this. Like you can see a head and shoulders, and you can also see a couple other things like a double top right here. Even though we did have a slightly higher high, that does look like a regular wave 5. But if we do see some sort of move like this, we still have support right around that's like 1700, 17,200 level. That's still nothing. That brings us back to August, and that's not going to be enough to clear a lot of this excess out of the system. And when I say things like clear excess out of the system, I mean, valuations, PE multiples. There's not enough revenue to drive these PE multiples for a lot of these other companies that aren't the mega cap companies. So you see Apple and Nvidia posting these monster results. That's great, but once you start having layoffs and people start losing their disposable income, then you get to the point where people stop spending money on, let's say like a QuickBooks subscription, and they just start tracking everything in a spreadsheet. That's what I did. When I stopped working for the man, I just created spreadsheets and just save cost. And that's what a lot of people are going to do once they get laid off or they don't really have a choice. But that just translates to less revenue for these larger companies. And it's going to be harder and harder to justify these PE ratios. So I would say, 9 months ago it was a little easier to kind of justify the PE ratios because they were putting up large revenue numbers, large large customer growth numbers like Netflix and things like that. But eventually that's going to slow down. And once that slows down, then your debt increases because you have to continue to give, pay raises and things like that for inflation, or you're going to do layoffs to preserve your earnings per share, so on and so forth. Right. So the macro level sort of developments are really what I try to keep my mind on as we're kind of, marching along here. And I guess I just wanted to say with it that something like this is going to be really small, or like this sort of correction will be small in the grand scheme of things. But I don't necessarily think it's going to take a long time, right? Like, again, bear markets take what, 2-3 years, 3 years for a bad one, 1.5 years for an okay one. With COVID, we didn't really have that much of a recession, really. People got laid off, but they just got rehired within 2 or 3 months anyways. And then with all the spending and things, that's what I feel like the foundation was for the inflation we have today was, the trillions of dollars that we spent on infrastructure, all that other stuff that just, turbocharged all the economy, which is, fine. But now we have to, now the chickens are coming home to roost, and we got to pay for that through inflation, which is of course an invisible tax on the people. So really what I think is going to happen, and this is where I might get some scoffs, which is fine, but and before I do this, like I'm not a doomsday guy, okay, but I do think that when you look at, or when you study other bubbles and other corrections, they all have different characteristics. Like that we had the housing bubble like in 2008, it started in 2006. Or really well before then, when you're giving people houses where they don't even have a credit check, or they're paying for everything in cash, they don't have an income source. like that's when you start to get into trouble. We have some things that curtail that these days, but some of the other excess that we have now is like margin debt. So margin debt is huge right now with all the different traders, and what that can do is that can cause a massively fast downdraft or some sort, like when you study bubbles, let's say 1999 into 2000, you can have a lot of these high margin debt sort of traders out there, or institutions really, where you start to see, even with just a couple percent decline in the market, you can start to see bankruptcies. Like we saw, what was the large short trading firm that just went under? It was like 2 months ago, I want to say. There were like a short selling firm. I'm sorry, I can't remember the name, guys, but they've been around for a while and they've uncovered a lot of different fraud.
Was that it, Gaines?
What was it?
Citron, I think.
Oh, that's one of them. I want to say it was like Huntington.
It didn't go under though. He just like closed shop.
Oh, okay. Yeah. There was one that has been open for a long time, and I'll have to look for that. Let me take a note here.
I think it's Hindenburg.
Oh, that's it. Yes, thank you. That's it. So those guys, they're a relatively large, like short selling sort of firm, but they still perform a very important function in the market. And you see a lot of these sort of firms kind of go belly up when it gets just to the end of major bull markets where people think it's going to reverse and it doesn't. And kind of like me, it's like every month there's a post about like, well, still holding those shorts, but the reality is those companies perform the yin to the yang. And when you start to lose those research firms that uncover fraud and some of the other excess and abuse that's in the system, I mean, the SEC isn't really doing it, right? So once you get to these points, that's where these things can kind of build up into a house of cards, where a lot of this like funny money stuff starts coming in and starts to manifest itself through excess margin debt. And also another thing that's a big red flag for what's going on right now with the markets. And it might be a little different after the last couple of days, but at least leading up to this, there was more options volume than there were actual shares traded in the market for like the first time ever or something like that. Or maybe it was like the second time, but that always precedes a big drop. And a lot of that is just because markets are on easy mode. Like all you got to do is click the buy button, buy every dip, right? It's worked for almost the last 2 years. So why wouldn't it work now? So you just keep doubling down and doubling down. You just keep martingale strategy, that whole thing. And then you get to the point where you have this huge bubble of excess, equity valuations that nobody wants to see deflate because they're so levered with their, margin capital that even a 10% decline will wipe somebody out. It'll blast your account to, 40, 50%, maybe 60% losses. So the reason I say this is because once you have a major event like this, where you have like a trend line breach, and there are some people that say like, oh, technical analysis doesn't really work, blah, blah, blah. I would beg to differ. There have been many times where I've seen markets breach trend lines and major trends and things like that. And like the patterns you see in these books, they're like, I mean, personally, you've got stuff like this, like at my desk. It's my, my technical analysis of financial markets, a little bit of light reading for the weekend, or my encyclopedia of chart patterns. So other than me being a giant dork, the reason I have those books is to study these longer term patterns. And as you guys are aware, like you study the wave theory and things, these things are fractal in nature. And what fractal means is really just, it's the same patterns, the same 5 count, 3 counts at the different time scales, and the 1 minute as the day, as the week, as the year, that kind of thing. So it's important to note that once you see these sort of major shifts, it's something to take note of. So again, while I'm not a doomsday kind of guy, what I think you're going to see here is a real like meat and potato sort of correction. So I think probably we might, if we do slide a little bit more, let's say maybe like the 18,400, that might scare the crap out of everybody. You could have a correction that kind of follows the retest of a trend line. Excuse me. You could have, sorry, let me do an ABC first. Then I'll show you the other one. Oops. Sorry, guys, 1 second. So let's say you got a, wave 3 isn't done yet, and it kind of sells down and freaks everybody out. But eventually you get some support, and then you might see something like this that would eventually retest this broken trend line, and that would still count as like a 50% retrace, or even 61.8. And why that's important is so let's do some measuring and kind of see where this might end up. So overall, let's say we do get this selling to this let's say this last point of support like back in September. This would definitely shake out a lot of people. Like today, I mean, the market was up 2% for Nasdaq. I mean, that's huge. You don't normally get 2% days when there's not excess in the market or like people buying dips and stuff. There just hasn't been enough time that's passed yet with markets selling off where the bulls, have the fear, right? Like they don't have the fear yet. There's a little bit of capitulation, but this kind of feels like a wave 3, which is why I'm thinking that this little move up today won't last as long as I think, or like I don't think it's as durable as people are thinking it's going to be. So even if we see something like this, where we have a longer term wave 4, here, I'll zoom in. It's probably a little difficult to see. So let's say we have like a more of a protracted wave 4, and we just keep testing this bottom trend line. That's the big key thing for me to look for is, do we actually see a breach of this again? Probably not. Now that it's been broken, now that becomes a major point of resistance. And you can see over the last couple of days here, all these top wicks and top wicks are, sorry, no, I don't want to go that deep yet. Top wicks are important because top wicks indicate selling into strength, but also the bottom ones indicate, buying into weakness. But you really need to kind of discern what is going to be the equilibrium point. And normally like the wave 4s that you see here are equilibrium points. But if we're still in like a wave 3, you'll see the characteristics of stuff like we've seen today, where if I pull up another chart, let me pull up what I sent today. Yeah, okay, here we go. So zooming in here, that's kind of what I think here. This is like a wave 4 in the larger wave 3. And once that's done, so let's say we do actually see a like a dip down here. We might see like a 5 wave sort of thing here that goes down to like I said before, like the 18,500 or something like that. That would not be good. We'll have a lot of doom and gloom in the papers at that point. But kind of zooming out here, if we do see this jump up to wave 4, then I think what we see is then I think what we see is as if you just see this continued march up here to test this, and also it's going to pull down these moving averages where excuse me, it's going to pull down these moving averages where then they become it's a moving point of resistance. So now that we have this 50 that's kind of dropping pretty fast, and then we also have the 200, once you get that cross there, it's called the death cross, and that signals long-term weakness for the market. So I did see that. I want to say it was on SOX earlier.
Yeah, it was on semiconductors. Yep.
Yeah. There we go. So, so again, I don't want to terrify anybody, especially if you're long SOXL. But I did get a question about that today. On like what is some of the reasoning for closing out the SOXL position? Well, this is a very clear ABC to me, and there's no guarantee that we're going to get an extension up to this level where it would have been a profitable position slightly, right, or at least exit at break even. So with this being a corrective move, at least at this point, doesn't really look like a wave 3 at this point. I don't think markets are ready for a wave 3 up to buy the dip, that kind of thing. And I do see some of your questions here in the messages. I will get to those in a second. But when you see something like this, that typically means that it's a wave 4, and we'll likely see some sort of, if we see a flat, it might do something like this. Who knows? It could meander around and do a flag or something, but ultimately, you should see some sort of finishing move that then gets bought up, and then that's your proper retrace. So this death cross here is not good for semiconductors. And if my opinion on the matter is that semiconductors are kind of like it's like a leading indicator for the market almost, as well as like Bitcoin, right? So semiconductors are that's a hot trade. It's the AI trade. It's really the one that's driving all this growth in markets. And once that starts to decline and kind of doesn't really have as much favor, there's nowhere really else to go, right? Like there's no other magic industry that's going to come up out of nowhere and keep the party going. So that's kind of where I think there's hallmarks of like the .com bubble here, where you had all these .com companies that were coming up and what was Cisco trading at? I mean, incredible valuations. What do they make now? They've made routers for the longest time, and they haven't really made a ton of other things, and they've kind of been eclipsed by a lot of other companies. And that's just the natural order of things. You remember when IBM used to be the coolest company on the block in the 60s and 70s and stuff. Well, now all that stuff's been replaced by tech, but tech is still tech's a lot inflated, mostly because excuse me, we've had this explosion of growth. This explosion of smartphones and tablets and really a lot of cool stuff. Explosion of technology, computing power, all these futuristic things here that have really, accelerated the quality of life. Well, some might argue the quality of life. I still, get upset when I got all these notifications going off all the time. But sometimes I just want to toss my phone in the river. But I guess you could say here, eventually these valuations get too stretched, and this is where I think we're at here. So there's, so kind of circle back here. If we do have some sort of, larger sort of decline here, this is still the first wave down. And if we do have this sort of retracement back, if we have, let's say the timeline gets a little, let's say a little shorter. So let's say, this ABC correction, this corrective move here only hits this 50% retracement. That should be enough for, a lot of people to get out of longs, especially if they added down here. But this is still something that, like, I would say I would prepare for as like the minimum base case, if that makes sense. So once there's confirmation of a bottom, which again, I don't think is here quite yet. I think that we're just ending the week on a high note because you want to entice the bulls to buy more and you want to sell into that strength. So if you're an institution and you want to distribute shares, that's your big goal, is to really just, keep tricking people into buying more and more, that they think that this dip is going to, just be temporary. And this is where, it kind of separates you from the pack a little bit, where if you can discern whether, it's an actual viable dip or not, that's I think what separates people from, just the normal investor to the people that'll actually stay solvent and have large bank account balances, once this whole thing blows up. So as an example, if you look at the the S&P, I have a trend line here. You know what? I'm sorry. It's on my other, it's on my S&P here. Like there's a big trend line that, here we go. So here, and I will talk about this in a second, but you can see that there's just a little bit of room down here that we can't, we haven't really seen yet develop. And this is a pretty strong sort of pattern, like a megaphone pattern. I do expect this bear target 2 to be hit. And that's kind of why I think we're still in this sort of like small wave 4 and a larger wave 3, which means that there'll be, there should be a little bit more coming. But again, if you're a bull, you're buying at this bottom trend line here, thinking this is a viable dip, everything's going to be fine. But when you're looking at other stuff, like longer term trend lines here, as you can see, like it's already been broken. So there's definitely a case for bull and for bear. It's just kind of, you got to, read the tea leaves a little bit more. So again, assuming that we had this sort of dip. Yeah. Sorry. So somebody say something.
And hey, how much Or retracing? Is this wave 3 bottom here?
Oh, good question. It's
I just want to know the likelihood that it's going to go down now that we shorted the crap out of SMS2.
what are you talking about, Jake? No, just kidding. I got to go a little deeper for that. This one, look, there's still this trend line here that is going to be difficult to get above, and if it does get above that, then that's a different story. But let's assume here that I'll tighten this up a little bit. The wave 2s and 3s and stuff, they're a little difficult as they're still developing to kind of get across. But if you start out here, so about 19,968 is your potential wave 4 retracement here. But
and how deep of a wave 3 extension is it?
It's coming up on 1.618. So if you, yeah, okay. So it's it depends on what you use as a wave low. So if I'm counting this as if I'm counting on this as the wave 2, then it's already hit it and bouncing. But and this is where the subjective nature of wave counting can irritate people. But again, wave counting is really just, it's about trial and error. And then, once something becomes invalidated, then you just have to, there's always a scenario B, C, D, that kind of thing. But it's still just an inch away from a key extension level, this 1.236. So this could be either wave 3 or it could be an ABC like this, where it's just a normal C leg extension to 1.236. Does that make sense?
Mm-hmm.
Okay. So I'm going to speed up a little bit here. I've been talking about a little bit more of the macro stuff than I guess I anticipated, but I guess longer term here, what we're looking for is this retracement. Now, if we do see a retracement at this 50% level, again, assuming that this is the bottom, or we're going to see a bottom, a little bit more extended, this is what I'll show on my longer term charts. So once there's a big update, I'll make sure that it's all all updated for you. Like these charts here, like the S&P and stuff. I adjusted all these levels this morning. There's all this stuff is pretty tight here. So if it does bounce on this 50, then highly likely it'll be an ABC sort of correction. And it won't be as deep. Just freehanding it here kind of looks like A equals C about there. But you can kind of see, and sorry, my counts and colors are different, but you guys can kind of see what I'm getting at, right? So if it does bounce lower on some strength here on like the 50, then what you can expect to see is another 5-wave down sort of C leg, and that'll be a lot more powerful than what we're seeing now. That's probably you might see some panic selling there. Like you might see 5-6% down days, like a real sort of market sort of crash. And again, I want to be careful with the word crash because I'm not saying it's going to have a crash, just saying that sometimes things just look a little weird and you're like, okay, maybe we got to take a step back and kind of reassess this. So to kind of finish up this macro level view, so let's assume here that we get a retracement that takes a little bit longer. Let's say maybe through April and May. Let me zoom out a little bit. And this all depends on what happens with tariffs and the economies and rates and all sorts of fun stuff. But that's where you got your old pal Gaines here looking out for you and trying to figure out what's going on. So if you notice, there's a very kind of convenient setup here, just as we zoomed out, like this point of control being around this like 15,000 level. That's for like the longer term sort of the ascension here. There was a lot of distribution back in 2022 with October, and that little this little path that we saw down here. We also have a lot of volume that just traded hands right around here, which is I think why you're seeing a lot of just a ton of volume down here. And And Mal did ask here, options expiring on Friday. Could it be the reason for a lot of those, red candles that closed today? That I think is, and sorry, and I went from like high level to super deep, but there are considerations like that, especially with like a lot of gamma expirations. But I think that all kind of ties into the higher level view of like, high margin debt, lots of gamma on market makers' books. That's a lot of risk for them. And they have to keep hedging that with futures contracts. So they're essentially inflating the balloon as it goes. But so, and Susan, I do see your question here. I will answer that right at the end with the different strategies here to hedge. So let's say we do see something like this where we do get this sort of massive 5-wave down, and assuming that it's relatively stable and there's no panic selling and stuff. I mean, we have seen this before. We saw this back in and this is the exact same sort of pattern, right? This is, I mean, it's like a leading diagonal, I guess you could say. It doesn't really matter what it's called. What matters is, again, things are fractal, and once you're in the same sort of pattern or like same sort of end cycle, usually a couple years, you see a lot of the same patterns materialize. Like you can see this larger one here is about the same as this over here, just smaller, right? And you want to use that to kind of infer like to kind of inform your analysis. Just because when you look at these charts long enough and you've seen enough of these different patterns and stuff play out, you kind of just like get a sense of what's likely going to happen, and that's sort of like the highest probability path. I mean, there's always those little wild cards that get thrown in there, but for the most part, I feel like we're on the back end of this cycle here. So if we do have this pull up to this 618 level, that is a very high probability reversal point if it's a wave 2 top. So from a wave theory perspective, 50% retracements are typically B waves, and they can be like triangles and consolidations. I'll sometimes try to draw like a box there where you can kind of see the different gyrations of the price. But for the most part, wave 2s can be pretty sharp. And I don't know if you guys are familiar with the law of alternation at all, but if the wave 2 is sharp, wave 4 is going to be kind of lazy and meandering. You don't typically get those lazy meandering wave 4s unless it's usually like a big sell-off, I guess you could say. So, kind of like how I was mentioning before, the bulls are all, having a great time and they're all buying the dip and stuff until they get wrecked. And then, they're not as enthusiastic to buy the dip. So this wave up here is called the suckers rally, and it's the suckers rally for a reason, because it's people continuing to buy the dip thinking that it's going to continue to go up and up. Well, I think one of the safe things you can do is, exit longs where possible. I mean, you guys can all draw these same trend lines and stuff on charts and things. But what you can do is, I mean, there's no shame in going to cash and sitting on it for a while, because then you have cash and then you don't have less cash because you didn't pull it out, if that makes sense. And again, I can't tell you what to do. It's just how, there are different strategies to trade this. Like some people want to leave all their cash invested. They don't want to have, tax issues or whatever. I understand that. Everybody's got their own situation. But if you're trading this, I mean, if you're fast and you're at your computer and stuff all day, you can get in and get out, easily with stops and stuff. That already, again, that's your top 10% of all traders and stuff. If you do use stops and the right proper hedging techniques and things. But if you get to a certain point where your strategy is still buy and hold, if you can skip a 30% correction, and if let's say you want to retire in 20 years, something like that. So if you skip a 30% correction, you don't have to work for 4 years or four more years. That's kind of how the math shakes out, where at, let's say, a 10.2% return on average, with the S&P, you can retire 4 years early. Congratulations. You just have to skip that one correction. So I guess kind of how you do that? Well, you can go to cash for the most part. And again, there's always a bull market someplace. So just because the indexes are dropping doesn't necessarily mean, let's say, like the quantum stocks, okay, they might be on a rip and a tear, but they still don't have much market cap at all. to influence any of the markets and the indexes. So what you're sort of betting on is like the ratio of market caps for whatever stocks you're investing in that are comparable to like what the price targets are going to be, income portfolios. Like if you do have a big sell-off, fundamentals matter again. And I guess that's kind of the main takeaway. What I was trying to get to is that there are stocks that will have bull markets and things like that. And Alex and his team, like, they're awesome at picking out, the different stocks that have, high growth potential. Even in bear markets, there are still great deals and things. So don't think that this is going to be like the end of the world. Okay. If we do have this, it'll be constructive, I think, long-term for the market, because one, you'll be able to start going long again and not feeling scared. And two, you can find some great deals on stuff. I mean, you saw a D-Wave today up 45%. Yes. So yeah, after a couple of days going down, that's a good day. But again, like a lot of these institutions accumulate these stocks at these low points, and once the market cap swells so much, then they start to influence broader indexes. So to kind of wrap up the macro sort of conversation here, and I want to get to some questions for you guys. Overall, there are two big scenarios. One is we're not done with this first wave down yet, and I think that's going to surprise a lot of people, especially if you see like a 20% decline from peak to trough. I mean, it's another 6% down, but that's not so bad. That's another week of 3 down days and 2 up days. And then if you see a pivot from that, let's say it goes up 10%, you could see another down leg, and that could let's say another 20% down leg or something. That takes you to net 32 or something like that. I mean, that's still a big correction. So if we go from like peak to trough here, 30% puts you at just slightly below where we were back in July of 23, which I still think is a little inflated. I mean, again, what I think and what I think and what actually happens are two different things sometimes. But still, a 30% correction is not off the table, especially if we have trade wars going on. I mean, you're seeing some of these things where I'm going to double your tariffs, so I'm going to double yours. Nobody's really backing down, and that's just uncertainty for markets. And especially with layoffs and things, and there's just a lot of uncertainty, and markets don't like that. You're starting to see a lot of erratic volume, and one of the things that I think is a hallmark of a bursting bubble is once you start to see these like peaks and troughs and stuff, where you see a lot of divergence between price and volume. But then also once you start to see a convergence after that sort of thing, that's sort of like your culmination of once like buyers and sellers are kind of at equilibrium, which is where I kind of think we're at right now, where it's sort of like the Bears' game to lose, but it's also the Bulls' game to lose if they can't continue to continue to push the market up. So with that being said, I can go a little bit extra. I know I talked a lot on this, but I thought it was a little important to kind of talk through some of the reasoning behind this. And I'll just touch real quick on like today. Oh, sorry, Susan, your question. So if you want to hedge your portfolio, what you can do is you can buy those long-term puts, or you could buy the short ETF without leverage. Sure, absolutely. So some people aren't comfortable with leveraged ETFs. Some people aren't happy with going short, that kind of thing. I kind of think that like we still might get a bit of a downdraft here, but I still kind of think that we're getting enough traction where we might start to see this wave 4 on a longer term scale kind of push us back up. And if that doesn't materialize, then it's I think a lot of people are going to be in trouble. But from a hedging perspective, you can buy those puts, but just know that 12-month puts, they're kind of like leaps puts, I guess you could say. They don't really have high delta. So if the market goes down, let's say 10% or another 10% or something like that, your return might only be about like, let's say 20-30% on, sorry, not 20-30%. It might only be like, double what the market fell. But if you have outsized longs still on the books, those will deteriorate as well. So you might not even come close to break even, depending on what stocks get hit the hardest. Like for example, the NVIDIA chart, and like Palantir, right? You saw Palantir blow up. Those stocks were parabolic, and other stocks aren't parabolic. So if you have a lot of like dividend stocks, like a lot of utilities and things like that, those don't really blow up. I mean, those are relatively stable and they pay dividends. So, and if anything, they might actually gain some strength as a sector in general, going up after once people are looking for some protection. I think bonds right now are going to be an issue because people aren't. There's not a lot of the U.S. government has so much debt that with the rates at the level they're at, the debt to GDP that we have, it's like post World War II GDP debt. Like it's unsustainable. So in order to, I guess, get that down, you need lower rates to service the debt. You just need to get it back under control. We don't really have clarity for that yet. So that's also why I think we're seeing a lot of buying up in metals. That's also why I think, gold's at 3,000, silver's headed up, copper, but I do think that equilibrium kind of changes once the rates decline and bonds become more attractive again, especially if there's a path towards, solvency. That's on the books, like a balanced budget, or you know what I mean? We don't know that yet. So in the next couple months, that's kind of why I think it's going to be a rocky road. And it's going to take a couple months to shake that excess out of the system and kind of, process what the new world's going to look like under, I wouldn't say, it's not even per administration or, president changes. Presidents can't really do much except for sign executive orders and stuff. Congress is the one that approves spending. And if they can't balance a budget, or, they have to, spend a ton of money, like that's really what you got to look at. It's not necessarily unilateral decisions. Yes, it causes uncertainty when somebody says something, but, I would look more at like what the Treasury is doing with the reverse repo agreements and, the Fed and stuff like that. Like, look at what they're doing behind the scenes. They're reducing their balance sheets. That's good, but it's also kind of bad because it's taking liquidity out of the system. And taking liquidity out of the system is everything. Liquidity is what drives the financial markets. So anyways, so yes, you can hedge with like a short ETF, especially if you're concerned about like daily compounding risks with 2x or 3x ETFs, that kind of thing. You can buy longer term dated puts. That should be fine, really. Especially if you wait for like a bounce like up here and you don't want to cash out any longs because you're just not sure it's gonna tank. And nobody knows for sure, right? But you can you can absolutely do that. It's just it's all on what you're comfortable with. Like I have bought some longer term puts before. I just didn't really get the performance out of the or the return out of the different. Well, you also have to have more than like a 10 or 20% correction to get a huge payday from something like that. It also depends on, what's your entry level. Did you do it at the money? Did you buy them out of the money? That kind of thing. I'm happy to, talk more about that if there's more specific questions on like the different styles, like time horizon or, delta. Like it's sort of a complex answer, and I don't want to, spend a ton of time. And I know we're already over time here. And please, if anybody's got to drop off or whatever, feel free. Hopefully this is helpful, you guys. That's the main thing I want to get across is that like, I'm happy to answer questions and I'm happy to kind of talk through like what I think and what I know, but at the same time, you guys are the most important because, you guys have your own different situations. So whether it's your retirement horizon, whether you're already retired and you're just trying to preserve capital, whether you're trying to generate capital through, dividends or, there's all these different strategies out there. But I think the main overarching theme is caution right now. Markets are flagging, the red flags everywhere with liquidity, unemployment, all these sort of things that have, just have yet to kind of manifest themselves in the data. But, right now I think we're kind of going through that transition period where people aren't really sure, especially analysts, on like what to make the call on next. Are we going to have a big bounce? We might, yeah. Sure, we could hit new highs, but I don't think that's going to happen this year. I think that the first 2 quarters of this year is going to be pretty dicey, pretty bad. But I think that by the third quarter, fourth quarter, we might have some stability. Again, this all depends on what happens. Like summer is pretty slow for trading, typically for seasonality. But I kind of want to see what happens with commodities first. Like commodities have to come down if inflation's going to come down. But it's kind of like tail wagging the dog. And, the rates need to come down the rates will come down if there's unemployment that increases. If the price of goods and things go down, like that'll of course influence, like metals and things like wheat and, oil, that kind of thing. So, so that being said, I do think next week probably what we'll see is to kind of transition here to the end, and then we'll do some questions. I think probably what we'll see is something like an ending diagonal here. I think I shared this with like you guys this morning, where you just see this slow, steady, like kind of decline, and part of this is all accumulation. So again, you need to kind of trick the bulls into buying your expensive shares, and they drive out the markets. And every day there seems to be a theme, right? So it's buying all day. That's kind of what we saw. We saw a trend day today for equities. But what we really didn't see under the surface was that the bears have been selling into this the entire time. You see all these these top wicks at these different levels. Like you also saw this here. You just see a lot of them, and you see a lot of this buying up that's been going on. But this was all last night, or last night and very, very early this morning. I was actually watching this last night, sitting on the couch for once, and watching just the bulls having to fight for every inch of ground that was gained. And then today, we saw just a big sell this morning, and they just kept buying it up. But if you also look at the volume over the last 2 days here, it's been declining. And even though you have those big surges in the morning, that's just a position for the day. So 2 days does not make a trend, right? So it's important for us to understand that with patience, the market will show its hand, and we should be able to trade patterns like this with great success. Not like Borat, like great success, but I mean like once you start to see a pattern that you've seen 100 times before, let's say there's a 80% chance that this thing heads back down and test these these different bear targets. And again, like you also you got to look at these trend lines and things and see, okay, there's still just a little bit left to go. And this is typical like wave 4 behavior where there's a lot of accumulation, a lot of back and forth, but it's either going to be a flat or an irregular flat, or it's going to be an ending diagonal of some sort. And once you identify that, and once you identify the connection points, like these 4 here, usually you can trade the 5th wave with great success or higher probability for profit. Also too, like I think I posted it yesterday where I showed the like the triple wave up. Sorry, not triple wave up. Let's see if I can pull it up. Sorry, I don't want to keep clicking around. I don't have it at the ready, but if you just go back in the main channel, you saw that I had like the flat correction. I put the little picture on there. I mean, that stuff changes pretty quickly, but how fast you change with that, I think is what the differentiating factor between whether you're successful at trading that pattern or not. So again, wave counts are important to know, technical analysis, but overall too, like if something doesn't make sense, ask a question in the discussion. I think you guys like discussion's been going great over the last couple of days. I think people asking really good questions. People are genuinely curious about these things, and I don't mind teaching if people like to learn. So with that all being said, again, hopefully this has been helpful, and I'm happy to take questions and stuff like that. And if I'm being too long-winded, please remind me. I yield the floor, senators.
I got a question.
Yes, sir.
What price action should we look for on Monday to validate or invalidate? I mean, based on the chart, it looks like we're going to get a trend line touch on the top of that wave 4. If we overdo it and go above that, we might start to get a little antsy.
Yeah, let me pull up the this one. I think is the better picture. So price action here, and let me move some of this crap out of the way. it is still making like a pretty symmetrical triangle with this, but and again, like these patterns typically are ending patterns for a larger wave series. So if this is a wave 4 and a larger wave 3, then we can expect once and I think you guys can probably see now that a lot of the price action has been bullish underneath the surface. That you can start to see a lot of this buying recently. And what you really want to see is like a trend day like this to kind of prove to the bears that like, all right, well, get your selling over with because the bulls are ready to take the ball and run with it. So you might see one more like capitulation move down here like this, and it might not dip this far. It might dip something like something like this, where it just makes a slightly new low, but still it's significant because that's the signal for for the bulls to now buy and then continue to buy without having a lot of fear of there being a massive decline. And I do think though that this pattern could turn into, like you said, Jake, it could probably, let's say, keep grinding up here, and we could make, could make like a double top or something, or you could see even a higher sort of sea leg extension where you might have like a 5 wave up. Like we might have only just seen here. It's actually a really good question.
I think that's what's going to happen. Just my
Yeah.
luck.
So we might have just seen something like this where, like Sunday night, you should be able to tell. So Sunday night, what you're looking for is a gap in futures. So normally once you see a gap, so let's say it's a gap down. So there was still some accumulation today at this top level. And that's typical of trend days because that usually starts the wave 4 the next week. Or if that ends on a day, usually it's the next day where you start to see some more selling. And that's where, we have ended the week here on a high note, and typically you do on Fridays. But what you're looking for is on Sunday night when futures open, if there's a gap down, like if we start, let's say right here, let's say it sells down and it gets bought up, something like that, it probably won't get much above the gap. Or if it does get above the gap, you'll probably hit just the minimum of where price ended today at the end of aftermarket. And then you'll probably see something like this, throughout the night. It'll be bought up in the morning as like your B wave. So that's kind of what you're looking for is just that very subtle, all right, the bears are out again, that kind of thing. But if you see a gap up, for example, like sometimes what the bulls will do is, so like we've had this, this trend line kind of like that. What you can see sometimes is you might see like a gap up like this, where it breaches the trend line all in one move. It takes a lot of money to do that, but that's still the signal to the rest of bulls and traders and stuff that, oh, jump on, and then the bears get squeezed and then they have to cover. So if that does happen, likely what sort of pattern you might see after that is, okay, so let's say this is that wave 5 and you finally get that. You probably still see some sort of back test somehow, some way, some irregular pattern or whatever that shakes everybody out. But then eventually you'll see some sort of rejection of that. And that would still make this like a just a channel, like an ascending channel. So you see what I mean, where like the patterns kind of change just subtly, but it's just enough where it kind of confuses everybody for a day, and that's by design. So again, like the market is specifically designed to separate you from your capital, and the people who are better at it do a lot better than others, right? So once you can kind of read these signals, and I think the important part though is so Jake, to kind of like close out your question, is like don't get rattled by it. Like if you see like for example today, let's say you were kind of trapped short around here, if you're getting kind of rattled because the market's up 2%, it just didn't go back down. That's just probably because it's the day's sort of the day's takeaway, and then Monday will be a different story. Monday we could see easily something like, oops, yes, this next series down, that kind of thing. So hopefully that makes sense. Now that I've butchered my chart here, I got to go back and fix it. No, I'm kidding. All right. Any other questions? Ben, you look like you've been wanting to ask a question for 45 minutes. Yes, sir.
I'm actually good. Thank you, though.
You're good. Go ahead, Will. Oh, gotta
Okay, can you hear me?
forget.
Long-term charts on Bitcoin, which usually follows the stock market, are up, whereas the long-term charts on the stock market basically are down. Is that a change in correlation?
So yeah, that's a good question. Let me see if I understood what you're asking. So basically, you're asking, so if Bitcoin is up, that's kind of like a leading indicator for the market, or for like rest of equities. And has that really changed? Am I understanding that correctly? Okay.
Yeah.
So I do think it's a good question. And what you could see, because this is where things get really complicated. Okay. And I'm going to try to make it as simple as possible. This pattern here off the floor could very easily be an ABC. And, just remember that, over Saturday and Sunday, Bitcoin still trades. So it could easily make this sort of, and it probably will, to be honest, it could easily make this sort of move up over the weekend, but just in time for futures on Sunday. Just watch, even if it extends a little bit higher, something like that, just watch, like on Sunday or something, there'll be some sort of move like that. And then maybe Monday morning, you might see a buy up for the rally or whatever, and then see a continuation down, because this is, it's a pretty clear trend with this. So if you're looking at it like a triangle sort of thing, the most important thing to notice is that the 200 daily moving average here is very important. This, you can see there's kind of like a battle between good and evil at the 200 here, where there's a lot of buying going on right here, only to just be sold down again and go lower. Like that's what is the frustrating part about these little consolidation zones, where you can still see, that this is a pretty big decline here, but this is also an ABC. I actually feel pretty confident that you will see this over the weekend, this ABC move, but again, because it's a triangle and it's kind of one of those ending patterns, you'll have 9 times out of 10, you'll have these five wave connection points there, and then you'll have your final lowest low after that wave 5. And then that's what sets up the next rally. And again, I'm just hand drawing this here just for illustrative purposes. But if you really want to kind of get a sense of what this might do, if it jumps up like this, it should reject after it gets above this 200, and then we should see lower levels here, and that should front run equities, depending on when that happens. So like, let's say it's Sunday night, then you could see that rejection there. I'll be looking at it for sure this weekend, but Sunday night I think is going to be the key. So Sunday night should set up the rest of the week, and then Monday, I don't know if you guys have noticed, but let's say like today, so Friday, we ended up at the high, right? Or close to the high, there's some profit taking. But what happens is this thing kind of rolls over, and let's say that starts Sunday night, and then maybe you have a like that morning drive rally on a Monday, but then that continues the trend that futures started the night before. And that's there is a strategy to trade that. Like you could buy the close, sell the open, or vice versa, depending on if it ended high or ended low, that kind of thing. And usually that's just sellers that have been trapped, just trying to sell on the market to get out of positions. Like, it takes a lot of money to do that, but if you have a lot of money, it's not that big of a deal. And that's kind of why you see a lot of those gyrations. But I see a lot of like wave 4s and things, or like B waves that kind of happen during the night, like in futures trading. And a lot of that is like, market makers hedging, or, big players, trading in different markets. But really it's to kind of set up that next day. So if you see futures set up the next day where, markets are, let's say it's 2% down, probably it's going to be a buying day. The bulls will step in, and I think you'll often find that like days that are greater than 2%, either down or up, you don't have that day the next day. So typically when a Friday is bullish, Mondays are bullish, but in a case where you do have these sort of like patterns that look like they're termination points, then again, assuming that there's no surprise, like, Jake's question, I showed you that the possibility of that might might head higher yet, but it still just changes the style of the pattern. So once, like, you can tell when things reverse, because then you'll start to see a lot more lift over like the next couple of days. So right now, once you see like a sell day, a buy day, like it just consolidates. Like you're pretty safe to just kind of sit with the hedge and just kind of wait it out and look at it. And again, like if you can target these zones to buy and sell at, like you can make a lot of money with those hedges. And that's kind of what we're doing with like MSTR right now. So did that answer your question? I'm sorry.
Yeah.
Okay. But yeah, I guess it does. It's just, it leads equities because it trades on the weekends. And I kind of think that might change a little bit once, let's say we get a deeper correction or something like that, and crypto isn't as cool as it used to be because everybody lost a lot of money, that kind of thing. That impacts sentiment, and it might not be the hot thing, in 6 months. Who knows? So for now, that the correlation is in place for sure. And typically things like, let's say, the 10-year yield usually is inversely related to like metals and equities and things, but not now. Now it's positively correlated. So it just kind of depends. Any other questions? Good questions today. I like these.
Hey, hey, Gaines.
Go ahead.
Sorry, I missed part of the webinar, so I don't know if some of these were answered already. I think I heard you talking a bit about bonds, but I typed up some questions in the Slack, so I'm gonna kind of repeat those and like kind of get your views on those.
Okay, yeah, perfect. Yeah, go ahead.
The question number 2 I typed up like around bonds, since I heard you talking about it already. What are your thoughts on like the TLT, TMF? I know that in your portfolio currently you're holding TMV.
Yes.
So yeah, just wanted to hear your thoughts on TLT, TMF, because like as far as I am understanding, it's like a kind of a protective presence in your portfolio, as well as what I've been hearing from Alex is the administration is like trying to improve bond prices and lower yields. So what are your kind of thoughts on all of this long term, and why are you holding the opposite of TLT?
Yeah, it's a good question. I've gotten this one. I've gotten a couple of DMs about this as well, and I took some time today, probably like 20-ish minutes to kind of look at my chart here and kind of just kind of like, where's it going? What's happening here? I do think that so inflation needs to go down. We need to have a couple of good CPI prints in order for the bond trade to be a good trade again. It just kind of seems like it's a little premature yet to be loading up on bonds, just because there is still that interest rate sensitivity. And like nobody wants to buy bonds if the underwriter, essentially the US, has such a high debt to GDP ratio and no plan to fix it. I mean, if you have deep pockets like trillions of dollars, you're not buying bonds right now. You're buying metals, because metals are traditionally a good inflation hedge. And also, now that metals have gotten pretty high, now I think the cycle is going to change. I think you'll probably see maybe like a 2 or 3 month window here where bonds aren't really the best trade, and neither is metals, because there's a lot of uncertainty. And there's just going to be a lot of like a lot of liquidity that kind of exits the system right now, and just kind of waiting it out. So why I'm long rates right now is because we still have, I think, maybe like another month or two here where we might see some hot prints, where, I mean, like the non-farm payrolls data that came in this week wasn't too bad. It's kind of pretty close to right in line. And I expected to see it lower. And that's still bullish for rates and bad for bonds, because it still kind of fuels that, just kind of fuels that sort of, I don't know, that the notion here that it's like, okay, well, once yields go up, equities are up because now they're positively correlated right now. And I think that we're not going to see the flip quite yet. And from a chart perspective, I think that like the 4.5 rate that we see right here is like this left shoulder. I think you'll probably see something like this where you'll see like a head and shoulders pattern develop. Because right now, we also saw like one of these death cross things here. And then also we saw the golden cross, right? So that's not really a helpful indicator for where yields are going to go. But it really does depend on inflation. And I think that we just don't have enough information yet on whether inflation has been tamed, or we're going to run into something different like stagflation. Like that's bad for everything. So we could have high unemployment, in the next 2 or 3 months. And then we also have higher prices because, inflation. And it like, there's, sometimes you can get in those, like the economy can get out of that equilibrium pretty quickly. And I guess long story short here with the bonds is that I just don't know if it's time yet for rates to go down. I feel like there's still excess in the system where the administration, like even if they want to bring down rates, they still have to have that short-term pain for the longer-term gain. So the short-term pain is still higher yields and high unemployment, and that still has that combination effect where you're gonna wreck a lot of balance sheets and things, and still that kind of creates that cycle of those layoffs and things. But once that all settles down, rates come down at the same time. And then, financing for houses improves. Maybe the Fed cuts rates. Clearly we saw back in September, the market wasn't ready for rate cuts because rates just shot up to the moon immediately after. And that was kind of my take on it. And again, I do think that this is kind of like a B wave. I don't know if it'll go up this high. I really don't think so. But for the most part, I do think that, keep your eye focused on CPI. And that should help inform. And once you start to see the CPI go down and like the Fed will always tease rate cuts or rate increases or whatever before it does it to see how the market reacts. Because those are big decisions. So if listen to how Jerome, Powell talks about this. And if he says, well, we're going to start to, pull all our basket of tools again. And, we're going to, lower rates or whatever. And if the rate shoots up after that, then you have your answer. Then it's too soon. Hopefully I answered your question. I don't know if I did.
Yeah, that makes sense. Thank you. So are you holding TMV to kind of reflect this view about yours, or is it like somehow hedging your portfolio, or is it just like what you said to reflect your view? That's the reason you hold, like because you think rates are going to go up.
Yes. So 2 reasons. First reason is, yes, I do think rates are going to go up short term. And the second reason is I'm not using it to hedge the portfolio. I'm just trading it. The portfolio hedge is really, how do I want to say it? Like, because we're trading like hedge pairs. Okay. So like TQQQ and SQQQ, those are those hedge pair trades that, 4 units of one and 4 units of the other, that's going to cancel each other out. So that's your full hedge. So that is like mostly hedging the portfolio. The only thing that's really not hedged in the portfolio is the short gold trade, which we won't talk about that. That's embarrassing. And also the short financials. But in a recession, bank stocks do terribly. So I don't really think that hedging financials right now is a good use of capital. I think that, we can probably make a lot more money doing something like, trading like MicroStrategy or whatever for the same capital as we would use as a hedge. But I don't really know if I would use bonds per se as a portfolio hedge, just because, and I think there's just a lot of uncertainty right now. Like the cycle has gone on so many years and so long, 18 plus years here, that we don't really have a good sense of what's going to be the next, bull market. It could be utilities, like, nobody knows yet. It certainly won't be, something like tech unless they can keep their balance sheet revenues, high and justify these PEs. But from a bond perspective, I just don't think that, the government has a plan to reduce the debt service or reduce anything while rates are this high. I think it was like 2 years ago, I read an article where somebody broke it all down where it was like anything above 3%, the government's screwed unless they make changes, to like overall spending. And, once you get above 4.7, then you have a real big problem with, fundamentally how the economy works, with how cash and liquidity is traded through, these deep pocketed institutions. So again, I think the bond trade's a little early, unless there's a plan in place to reduce the debt. And I think that the rates are going to be a little bit higher for longer because they need to, again, they create that short-term pain for longer-term gain. And they need to kind of weed out some of this excess in the system. So let's see. So you asked about the hedge. So really also I have a large position in TMV, and I want to get out of it. So if we were able to get up here to about 4.44, the position I have should be in the green. And then I'm going to close out all yield trades. So no TMV, no TMF, and I'm probably going to focus on something else, maybe more like shorting metals, depending on what comes out of the next discussion with the Treasury or the Fed, if that makes sense. But yeah, again, it's some markets are just like, I want to get out of it because I don't know what direction it's going to take, and you always want to stack as much probability in your favor as you can. And as far as I'm concerned, I think that it's a little too early to pick up some bonds and stuff and do some TLT just because it's I just don't know if it's the right portfolio hedge, depending on, and again, I don't know what your situation is, but I just think there's better opportunities that can have some more movement behind it that are better to hedge your portfolio. So hopefully that answers that.
Yeah. Thank you.
Any other questions?
I have a couple more, but if other people have questions, I'll. So other question was, I think you might have touched on this, but like I kind of want to understand like your longer term view, maybe like 5 years view. I don't know if you like think about it that way. Like from what I gathered, I missed part of the webinar, but from what I gathered, you're saying that this is beginning of a correction or a recession, right? Which might last a year or something like that. Then we may have another bull market, then another. I mean, like what I'm starting to sense is that like last time we had like such high inflation, maybe we realistically got to like 20%, like 15-20%, and maybe next time we go 20-30%. At that point, like the debt is like, it gets to a point where the financial system kind of could collapse. So like what is your longer term, like 5-year, 10-year view on this? Yeah, kind of wanted to get your thoughts on this.
Yeah. So you said something there about like collapse of the financial system. I think that the systemic risk to, I guess, the market at large is the government was in a much better position to bail out institutions or support a recovery back in 2008 versus right now. I think that there's been so much money that's been spent on, and that's where you use that word unprecedented again, right? And again, this is nobody's fault. It's just accumulated over time. And that's just the nature of the beast. You have these booms and bust cycles. It's really it's no cause of one person. So I think that the government has doubled down on the, it's the wealth creation effect. So it, kind of started kind of with Greenspan, and then all the different Fed chairs really accelerated under Bernanke. And what these guys are doing is they're trying to keep rates low, so it keeps elevating the market. And long term, many years down the road now, we've seen the effects of that, where these low rates have created extraordinary growth in the country and even the world. And what's the problem with that though is that eventually you've financed so much of this through low rates that you've gotten bloated as a system. And now that we've had so much debt GDP ratio versus what we did have in like 2008, 2009, the government can't spend trillions of dollars anymore to bail out, like let's say Bear Stearns, right? Sure, they can step in and help out and stuff, but like, and they can put things on their balance sheets, but that just adds more debt. And especially if we have high unemployment and also higher rates because nobody wants to buy junk bonds, right? Like people have been sold this bill of goods that the United States has the most stable bond market in the world, and that was true. But like when Moody's downgraded the United States bonds from AAA, that had a lot of shockwaves in the bond market. And to be fair, they were correct to do so. I did my master's thesis on the credit bubble and the rating agencies and stuff like that. So pretty intimately related or intimately knowledgeable on like what kind of caused all that stuff. And we're kind of seeing that stuff again. Only the problem is we can't finance a bailout now where we would have been able to finance a bailout before. And 5 years down the line here, if we do have deep recession, pretty decent unemployment, that's still tax revenue that's not being contributed to the to the base. So that accelerates the problem. So I mean, like all bubbles, they rhyme, but they don't have the same sort of catalysts and things. But I think the part of the problem that we're going to see in the next couple of years is we just can't get the debt under control, and that accelerates inflation. And that's that tax, that invisible tax on the people, which keeps that cost of living high and their quality of life kind of down. And there's lots of different people who've studied like the Great Depression and stuff like that. I don't know if we're going to have like a Great Depression kind of thing, but I definitely think that a deeper recession is overdue. And the funny thing about it is they'll never tell you that you're in one until GDP says GDP has been negative for a quarter. Well, GDP is a lagging indicator by like 18 months. So by the time you see negative GDP, it's already too late, man. Market's already probably been down. So that's what I think is happening right now, is that all these deep-pocketed people are front running the economy because they know it's on the slippery slope, and it's only a matter of time before these PE multiples have to catch up. So they're taking profits while the taking's good, and they're going to sit on some cash and wait to see what happens. So from a 5-year perspective, I think that we have to go through kind of a brutal bear market in order to set up the next 10, 15 years of growth. And I think that that'll get a lot of that excess out of the system. That can bring debt back into alignment, kind of reshape, remold the economy a little bit. Because we've gone from manufacturing to service-based pretty quickly with all these different tech companies and stuff. But yeah, I mean, it's kind of like it's fun, but also terrifying to think of. So yeah, I just I guess the main thing, again, to kind of circle back, is caution. So there's no shame in going to cash and sitting on it. And the fact that you guys have, invested in yourselves by, let's say, subscribing, right? Like you at least are at the forefront of these things where if you have a question like, what do you think is going to happen tomorrow? Like I can hopefully answer that. And, people like Alex too, like Alex is very, very smart. And, all the different people that help him with Sestrian, they're very, very smart too. And, we're trying to look out for you guys. I mean, again, we can't give advice or whatever, but you're still good people. You're still investing in yourselves, and I want to try to help where I can. And it takes a village to beat these guys, but also to stay on top of what's going on, because you don't want to be caught on the wrong side of a deflating economy, right? And these things come in cycles. So overall, 10, 15 years, things might be totally fine, but next couple of years might suck pretty bad. We don't really know. So I don't want to be doom and gloom. I try to stay positive about these things, but if we can figure out how to trade it, right, then we can make tons and tons of money off it. So hopefully that's my plan. Then it won't matter if you're in a recession. If you got a big bucket of money you can pull out. So or back up the truck. All right. Any other questions? Could probably do another like 5 minutes here, and then I gotta drop.
So like if in like a recessionary scenario, how do you kind of protect yourself? Like, is cash still the best way? Is it the classics like real estate and metals? Is it Bitcoin? Is it like what do you?
Yeah. Oh man, great questions. Great question. So I would say I don't think there's any real safe place to put money after you've had such an excess of a bubble. Definitely not tech. Like think about it like from a fundamental valuation perspective. Like look at a company like Intuit. Okay, Intuit, their stock was worth almost $700 a while back, and if you take their shares divided by book value, they're worth like $118 a share. Like that's quite the fall from their current valuation. And a lot of these other companies, like if you just use something simple as Graham's ratio, you should be able to tell whether a company is overvalued or undervalued. That's what Buffett uses. That's a very easy way to tell. Like, for example, you guys were asking about quantum stocks like D-Wave. And I'm like, hey man, it's at like sub $5. It's undervalued. So I want to pick up a bunch of shares. And we got lucky today, but longer term, that's where I'm looking for is like to kind of protect yourself against these sort of things. You want to look for stocks that have a lot of growth potential, that are either like have new innovative ideas or solutions to problems. Like let's say a company comes up that has an 80% efficient solar panel versus the 40% that we have today. Like that's the kind of stuff where if it's proven technology, buy in. That's the kind of stuff that's going to pay off longer term. And even though let's say there's 5 or 6 companies right now that do quantum stuff. Let's say only 2 of them survive in 10 years. Well, they should all still rise and fall with the tide, or with the industry tide. So if one has poor management, they'll just fade away like like other companies do. But in order to kind of weather the storm, I don't think real estate's a good place to be, because especially corporate real estate, that's going to be a disaster. Especially if you have like thinning workforce and stuff. There's just too much office space. And especially with work from home, it's like a perk that companies can offer their people for free. Even though they want people to come back in the office, they're still just consolidating office spaces. Like again, Intuit, for example, they had when I was consulting for they had, oh my God, like 35 offices in the US, and now they have 12. And they've been consolidating over time, but they also knew that they also have a great indicator of the economy, which is small business growth and small business startups. Like a number one driver of the economy is, what is the percentage of people opening up small businesses? And once that starts to decline, that's usually a leading indicator that the economy is going to as well. There's just not enough available capital that people have where they feel confident to start a business and then roll with it. Like for example, like right now, I certainly wouldn't put 50 grand into a new business venture, just because nobody knows what the hell is going to happen in a couple months, if not weeks, really. But I think one of the better ways to kind of, I think, prepare yourselves for something like this is, so like if you have a house and you've had it for a while, odds are you've got in before the bubble of housing and stuff, especially if you're in like a metro market or something like that, where there's a lot of acceleration in values. Even if it corrects 30%, you'd still probably come out ahead if you bought 7-8 years ago. So you can hold on and stuff like that. Especially if you have like a low interest rate loan on a house, like a mortgage. Like let's say you got a 3.5% loan, like hold on to it, because you're not going to get that now. And who knows? Like inflation still keeps going and going. I don't think it'll be like the 70s, but I certainly think that that's the kind of, they call it good debt, but no debt's really good debt. It's still low cost debt, right? So it costs the banks more to service the debt than they're making from you on the debt. So you essentially bought a house using other people's money, and they're not getting paid a lot of money for loaning you the money. So it's like, it's still kind of a good deal if you look at it. So again, real estate, like houses and stuff, people need places to live. So that's not a bad thing, but not corporate real estate. I'd also say number one thing is, if you have like credit card debt or something, that should be a top priority. Pay off your highest interest rate stuff first and get out of the debt spiral. So if you do have some sort of unfortunate circumstance where, let's say, you're laid off from your job or something, or you've made some mistakes in your portfolio and you're retired and you got to make up the gap somehow with income, or who knows, maybe Social Security explodes. But at the same time, like to be prepared for that is to have less cash outflow every month. So you can do that by, that new UTV that you bought, that kind of thing, where it's $300 a month. Well, maybe it's time to sell it, that kind of thing. But again, those are just little things to consider, right? So again, to kind of wrap it up and bring it full circle here, because I do have to drop. But I think overall, if there is going to be some sort of deeper recession, you want to prepare for it by not being reckless with spending. So like you don't want to go out and buy a vacation home right now, because market's not at peak, but it's just below peak, and you're going to overpay for real estate when in 6 to 9 months it might be 20% off, right? So it's just kind of like it's like you just kind of want to hold right now, just hold the line, right? So I mean, if other people have any suggestions or things that might be helpful, please chime in. But I guess as far as I'm concerned, it's like the less money that you owe other people, or the less like cost that you've taken on every month, the better, and to weather a storm like that. I mean, I'm certainly not giving up my Netflix. I'm not giving up my Spotify account, but that's pennies on the dollar compared to a mortgage, right? So, yeah, you got to make choices. All right, guys. Well, I think that about does it here. We went way over, but still good questions. I think that this is still an appropriate time to do something like this. I appreciate you guys all joining. I think it's always a good discussion to have with like-minded people. And I also want to, just thank you in general for like joining the service and subscribing. My kids thank you. My wife thanks you. This is how I pay my bills. So I appreciate you guys very, very much. So thank you guys. Have a wonderful weekend. If you got stomped on today or this week, just try not to let it bother you. Right? Go have yourselves a cocktail and we'll deal with it on Monday. All right, guys. Have yourself a wonderful weekend. Talk to you later. Bye.
Thanks a lot.